More infrastructure money than ever. Fewer projects see it. The record investment numbers are real. So is the concentration. Record capital flows are real, but the evidence points to a more concentrated market. Larger managers are capturing a disproportionate share of fundraising, digital infrastructure is absorbing investor attention, and some clean energy projects are facing weaker federal support and slower contracting signals. Bloomberg NEF reported in January 2026 that global energy transition investment reached $2.3 trillion in 2025, up 8% from the prior year and the highest figure on record. Infrastructure funds raised close to $300 billion across 2025, also a new peak for the asset class, according to CBRE Investment Management's Q1 2026 Infrastructure Quarterly. PwC's Global Infrastructure Outlook, published in April 2026, projects annual infrastructure spending rising from $4.4 trillion in 2024 to $6.9 trillion by 2050. The numbers, read in sequence, describe an investment environment of extraordinary scale and sustained momentum. They also obscure something that matters considerably for anyone trying to close a specific deal. Capital availability and capital accessibility are not the same condition. The record flows are real, but they are moving into a narrowing set of destinations, managed by a shrinking share of players, under underwriting criteria that have become materially more restrictive over the past 2 years. For finance and operations teams with infrastructure projects in their pipeline, the headline number is close to irrelevant. The question is whether the project in front of them fits the market that actually exists in mid-2026. Infrastructure capital is concentrating among fewer managers and one dominant theme. The CBRE investment management data shows that capital inflows into infrastructure funds are heavily concentrated, with the top 10 managers accounting for 44% of all fundraising. Investment News, reporting on the same period, noted that infrastructure fundraising rose from $99 billion in 2024 to more than $250 billion in 2025, but that the increase was driven significantly by several funds larger than $10 billion, reaching a close. The market got bigger at the top. Mid-market and emerging managers are still active, but they are chasing a smaller proportional share of institutional allocations. The thematic concentration is equally pronounced. Digital infrastructure, and specifically data centers, has become the dominant pitch in infrastructure fundraising. Summaries of Bloomberg NEF's 2026 Energy Transition Investment Trends report put data center investment near $500 billion in 2025, ahead of total solar investment in scale, though Bloomberg NEF has not published that figure as a standalone primary release. The infrastructure investment cycle is not neutral across technologies. It has a clear preference shaped by speed to market and contracted load certainty. And that preference is drawing capital toward digital infrastructure and away from the transmission, distributed energy, and mid-size clean energy deals the broader grid build-out requires. The federal withdrawal left a gap that private capital has not filled. The concentration problem is compounded by a simultaneous withdrawal of federal capital from a segment of the market it had previously supported. The Department of Energy's DOE Energy Dominance Financing Office announced in early 2026 that $83.6 billion in loans and conditional financings from the Biden era were being canceled or restructured. Approximately $9.5 billion, specifically in wind and solar projects, were being eliminated and replaced with investments in natural gas and nuclear uprates. A $1.8 billion loan to Arizona Public Service Company intended to finance transmission and renewable projects was among those pulled. The assumption embedded in many infrastructure proformas built between 2021 and 2024 was that federal lending programs would provide a cost of capital advantage for projects that could not yet attract mainstream institutional financing on their own. That assumption has been largely invalidated. Private credit, ESG-oriented lenders, and green banks have moved to fill some of that gap, but not necessarily at the same terms or volume, and not for every project category that federal lending previously supported. The American Society of Civil Engineers, ASCE 2025 Infrastructure Report Card estimates the U.S. energy sector faces a $578 billion investment gap through 2033, even if existing funding levels are maintained. If federal support recedes further, that figure climbs to $702 billion. What the divergence means for companies planning around contracted supply. The American Clean Power Association, ACP, reported in March 2026 that while 2025 was the strongest year on record for clean power deployment, with 50 gigawatts GW installed, power purchase agreement PPA activity fell 27% year over year. That divergence between what got built and what is being contracted for the future is a direct signal of what the financing pipeline looks like further out. Projects that closed in 2025 were largely financed in 2022 and 2023 under market conditions that no longer exist. The 27% drop in PPA announcements is an early indicator of what the 2028 to 2030 deployment picture may look like if the current financing environment persists. For corporate energy and sustainability teams, the practical exposure sits in that gap. Decarbonization timelines, Scope 2 accounting, and load management plans that assume contracted renewable supply will arrive on schedule are built on project pipelines that now face a financing market with less federal support, more restrictive institutional underwriting, and a gravitational pull toward data center and digital infrastructure deals. The record capital flows are not evenly distributed. The projects that finance and operations teams are counting on are, in many cases, competing for the portion of the market that the dominant capital thesis is moving away from. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.